Welcome to Clicks and Bricks Podcast. We talk about the entrepreneur mindset.
If you get one shot at this, what kind of shot are you going to take?
If we forget who we are, they're going to forget who you are.
You've got an adversity story that's out of this world.
Everything from that Main Street brick and mortar to that billion-dollar manufacturer.
Welcome back to Clicks and Bricks. Today we're talking with Ken LaCroix from Insightful Partners. I think we're going to learn a lot about mergers and acquisitions today, so stick around. I think this is going to be a lot of fun. Ken, thank you for joining us today.
Thank you very much for having us, Ken.
Before we jump into the questions and answers, can you just tell us a little bit about who is Ken LaCroix and what got you into this, small and medium enterprise mergers and acquisition market? It's a pretty wild market to be in.
Sure. So we are virtual and fractional CFOs. We've been doing it for a while in this space. Companies in the $5 to $50 million range, they're just starting to add their finance function. It's kind of hard to add a full-time position to that. They kind of need a little bit of CFO, a little bit of financial analyst, a little bit of strategic thinking. And that's hard to find in one person, hard to attract the right person to your organization, and certainly hard to pay them. So that's where the fractional role fits in. And again, we're bringing that finance function to historically just accounting department run businesses. We are, of course, the anti-accountants. We don't do taxes. We're not your CPA. We don't do your accounting for you. We take the numbers once they're done. Once the accounting team has finished the numbers, we take them, we apply them to other numbers. We have a lonely numbers concept. We think a number all by itself is a lonely number. We combine it with operational data, external data, HR data, sales data, CRM data, try and tell an effective story around those financials. As we know, those financials are old. They're very accurate, but very old in terms of business decisions. So we like to put more current information that might have a little bit of noise to it, but our job is to find the signal in the midst of that noise and help you make better decisions with data.
All right. Couple things really quick. Fractional CFO. I always keep a CFO on staff. And I do that because I know that any financial decision, it's his personal liability, not my liability. And I, as entrepreneurs, we kind of run fast and we're risk takers, and we need to have that safeguard, I guess, between us and the government to make sure that we're following all the proper rules. Does a fractional CFO give you the same kind of protection?
It's a great question. So you're talking now about governance and running your business and signing off on financials. There's many different ways that it sort of gets talked about in the vernacular, or some way of certifying financials. We don't do that. The CFO that's going to sit as a true chief financial officer in your business, be named as that chief financial officer, their pay is going to be somewhere between $250,000 and $500,000. And they will do a very good job at doing that. Most businesses don't need that in the space that we play, at least. They're private businesses. They're using their financials only for internal use. The bank may take a look at them, but they're not making lending decisions based upon those financials entirely. So there's not really the need to sign off on financials. There's not the need to have that level of governance. If you want that, that's what it takes. Or you could outsource that to a CPA. You could get an audit. And audits run anywhere from $15,000 to $75,000 upwards as well. Again, there's a lot of risk when you're certifying financials. And so there's a lot of fees that need to get charged to cover the insurance around that risk, especially if you have a pending sale or if you plan on selling. We run into situations with our clients where their audits are $35,000 a year historically. And they mention, oh, by the way, we're probably going to go out to the market, put ourselves up for sale this year. And the audit fee is now $100,000 or $150,000. So there's just a lot of litigation around that. Short answer is no, we don't do that because we're not getting paid anywhere near that number. We try and make ourselves very affordable to the smaller business owner.
Yeah. It's phenomenal. I have a small business under $1 million revenue, and I balance the checkbook every morning, and I send it to the accountant, do the taxes at the year. I also have a bigger business that has a CFO full time and all those things. Occasionally, that smaller business, I'll be trying to get, some financial situation done, and they ask me for audited financials. I'm not, what is about me doing it, not auditing it every day? Isn't that an audit that I'm doing, or what is the difference?
So again, vernacular, tossing around terms. For the most part, audited financials means a compliance engagement from a certified public accountant, a CPA. And that's what I was referring to earlier with $15,000 to $100,000 fee to get that audit. They will test your transactions. They'll review your procedures, your policies, your internal controls. They won't detect fraud, but they will they'll make sure that there's not opportunities for fraud. And they will basically say that these financials reasonably represent the operations of the company for that period of time. So banks like audited financials, outsiders like audited financials. That's where that sort of comes into play.
Yeah. And if you're over $1 million revenue, or actually I would say if you're over like 5 or 10 employees and you're paying commissions or things like that, you probably should have maybe not a certified audit, but somebody audit your financials every couple of years, because there's some weird things that can happen in your ARAP world.
Absolutely. We run into that all the time. We run across new clients and we wonder why they made this lawn furniture purchase on the company credit card. And they say, well, we don't have any lawn furniture here. And lo and behold, someone's found a way to use the card for something nefarious. So
yeah. So it's a good practice. And can you get an audit without the certification? Like, is there a difference between the audit and the protection?
Again, I can only speak to the specifics of the CPA world and what an audit means to a certified public accountant. Audit, you're doing an audit every day on your bank account yourself, right? As you mentioned before, but that's not typically thought of as, again, the loose word audit. It's really audited financials in accordance with generally accepted accounting principles, blah, 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 right? We shortened it to audit, but there's a very specific thing there. And it's
CFO,
regulated state by state.
His favorite thing to say to me, that's not GAAP, Ken.
Uh-huh. Yep.
That's not GAAP, Ken. You can't do that. Can't do that. You can't do that. I'm like, ugh.
Yep.
It's frustrating.
Yep. And to remind everybody, GAAP is GAAP. It's not GAP. It doesn't stand for anything other than generally accepted accounting principles. Which
it is my GAP.
There you go. There you go. There you go.
Ken, you've worked a lot of businesses going through rapid growth, restructuring, and mergers and acquisition. What's a misstep you see companies make repeatedly in those phases, and how do you counsel them to avoid it?
I think the biggest misstep we see is the business growing and the reporting systems not keeping up. When you're at $1 million or 5 or 10 people, $2 million, I don't think financials really add much to your management. You're there when it happens. You mentioned earlier, you're looking at the bank account every day. We think that's vital. That's the best way to get a handle on what happened in your business yesterday. But as you grow, you all of a sudden have 2 warehouses or 4 warehouses instead of 1. And when you have 1 warehouse, you can walk the floor of the warehouse. You can walk the production line. You can walk the manufacturing system and get a better idea for what's happening than any report will ever give you. But once you have 2, 3, 4, 5 of those things, warehouses, product lines, channels, if you've been selling historically to distribution, you have 4 customers. If you decide to sell direct to consumer, you might have 4,000 customers. So there's just differences that happen that make it hard to keep up informally. And they haven't invested in the accounting side of things because it hasn't been helpful to them. There's no reason they would. I often say that if business owners didn't have to file tax returns, they really wouldn't have accounting departments. I check the bank account every day, and then I cut checks when I need to, and I call customers to pay me. So, it's really this transition from an informal
Get
accounting.
out of my head, Ken. People ask me all the time, like, how do you do all that? I'm like, it's just managing a big checkbook. It's no different. I have more vendors. I've got a few hundred vendors. I've got a few hundred, but at the end of the day, for me, being the person that signs the checks, it's not that much different. It's a longer process, but it's the same process as I would do at my house in the bills at home. I just got to make sure that somebody else is looking at it for that weights and checks and balances, right? To make sure that one person doesn't have too much control.
Well, and at some point, you'd like your business to be such that you're not the only one signing checks, right? You'd like to be doing something else, visiting customers, playing strategic roles, visiting competitors, all those things that really matter to the business, not signing those checks.
Yeah, I like signing the checks.
And that's what we run into is people like you holding on too long to that function.
Yeah, it's okay. I have somebody else print them and set them on my desk, and then.
Yeah, and we think printing checks is the old way to do it as well, right? We think that all should be handled electronically.
I don't disagree with you, and there's still some reasons we might want to write a paper check.
Sure. But again, I want to tap into that passion. It's that control that you want. I don't want to minimize your desire to have control over your business. That's a wonderful, wonderful, wonderful thing. It's just that at some point, your business hopefully will outstrip your ability to write checks yourself. You'll have multiple locations, multiple countries you might be operating in. So those are the growth things that we want to happen. So just
Yeah.
making sure that you've got a system in place to handle that and move things along. We think finance is a good addition to the team because finance helps you look forward a little bit rather than backwards. Accounting typically looks backwards. And as you grow, you might want to know what's going to happen tomorrow rather than what happened yesterday.
Yes. Let's talk about that control thing for a second, because you're right. A lot of entrepreneurs have this problem. And I know that I have this problem in some scenarios, right? How do you go from the guy that signs all the checks? And I'll tell you, I have a procedure that at least 2 weeks every year, I don't do it, right? So that I know that somebody else in the company can do it if I'm not there. And that's part of my agreement with the insurance company. What are some other ways that we can ensure that the systems are set up that don't require the founder to have the noose around his neck 24 hours a day?
So realize that when it comes to controlling expenses, if it's the check signing part, the payment part that you're reviewing, it's too late. That's not when the expense happened. That's when the disbursement has happened. So let's move upstream and let's look at invoice approval. We would much rather have the entrepreneur, have the owner approve invoices. Well, do I need to approve an invoice for the rent? No, because that's the same amount every month for at least a year, usually a year, sometimes multiple years, or we know contractually that's what it is. If there's 2 rent payments, then we might have a problem, but that's an anomaly. We know that should be. So then we're saying, well, now approve invoices from these vendors only, or for this amount only, for over $5,000 or over $10,000. Or we can go further upstream and input purchase orders, where now you're saying, look, I will approve this purchase order for this amount. We've agreed to pay this number. And I only want to know if there's a difference in the invoice price or a difference in the quantity, or tell me about those exceptions, because everything else I'm fine with. I've already approved it. And then you can actually have a purchasing department that has budgets that works within, and you say, well, I'm going to give you control of your budget to make these purchases, to do these things. And if you stay within your guardrails and your guidelines, then I think we're okay. The check signing process is when you can't do anything else about it other than delay payment. But all those other places is where you have an opportunity to say, I think that price is too high. We don't need that many of them. I thought we bought this from someone else. Interesting. I don't know why we're doing that. Didn't we buy those before? How come we don't still have those? How don't we have those in the warehouse? Those are all the questions you should be asking.
I love it. It is very, very important stuff. And even if you're like me that wants to maintain the control, have a system in place that knows that you can go on vacation,
Yep.
that you can get sick and your business still runs. Like, these are wildly important things. And I'm going to go off script here quite a bit because I just want to talk about technology for a second. What are some of I like how you said, budgets and approving purchases for a certain amount for certain things, standardizing. And I have a statement in our business that says, if it can be automated, it will be automated, right? What are some tools that are out there now that can help an entrepreneur approve some of those recurring things, even like when you're under that $1 million range?
So we think accounts payable, AP, paying the bills automation is the lowest hanging fruit in the organization for this. So a couple of different ways of approaching this. Number one, we use bill paying platforms where basically the platforms will ingest invoices that are either emailed directly to them or that are invoiced to them in the system. There's some method of getting those invoices in there, including just scanning them in if all you have is a paper invoice. But most things start electronically, so that lets us just keep it electronically. Those are input into the system for approval. You can have different approval workflows. 2 people can sign off. 2 people have to sign off. 1 person out of the 2, you can have a round robin, any one of these 5 people. It allows you to input the invoice into the system, but it prevents it from being paid. And one of the biggest problems we have with our accounting and using the numbers is that people will hold on to invoices and not put them in the system. And so an invoice that's not in the system is completely unmanaged. They think that they're doing a good job by not putting it in the system because they're implying that once I put it in the system, it'll get paid. So we like everything to go in the system. Then we can manage them. We won't pay them. They need approvals to pay. Once it's in the system, we can look and see what the last 5 invoices are. We don't have to go to the filing cabinet to find it. We can look and see what our payments have been year to date. There's all kinds of reporting we can do around that. And then the important thing is the vendor understands things. We can send notices to the vendor when we receive the invoice, when we process the invoice, when we pay the invoice. They know to get it an electronic payment, a check payment, an ACH payment. Now you're not managing their expectations. They're sort of managing it themselves. So now there's no phone calls to AP, and you have an electronic copy of everything you've done with those vendors. You have complete control over who approved it, when they approved it, why they approved it. So that's the bill paying platform. There's also an opportunity in your disbursement or credit card accounts. We run into businesses that, for good reasons, have mileage or bonus type credit cards, and they'll get lots of miles they can do things with. But we also know that there are platforms out there that are much more specific in what they do, that can let you set up cards virtually. You can set up disbursement cards that are only good at these types of retailers. So if someone tries to use the card at Home Depot to pick up some home improvement items, the card doesn't work. You can add credit to those cards all on a console. You can reduce credit when you terminate someone. You can get rid of that credit card immediately. You're controlling things that historically the credit card company would do, and that gives you insight right away into what's happening. And again, those are automated. Those automatically go into the accounting system, and it's just a great way of managing those things. You can use those for budgets. Some of my clients will say, here's a credit card that we use for spending for marketing, and I'm going to give you your $10,000 a month or your $2,000 a month, and that's what you've got. And now they can't spend any more on that credit card, and they don't have any other credit card other than their personal credit card, and now they've got to reimburse it. So it's another way of implementing sort of budgets without having budgets. So those are some examples, and the marketplace is creating more and more of those technologies as we speak. And we think that's just a great place to look.
Absolutely. I've got a couple of comments there. One thing that I've been doing is I've been creating a virtual credit card for an employee's LinkedIn. Like, this is your credit card for your LinkedIn profile. So put it on there. This is what you use for your LinkedIn. And then I can terminate that card anytime I need to. It's been a game changer, those virtual cards that you can set up for very exclusive things, tag them, and then remove them from the system, and they stop charging your stuff. That's random applications on credit cards I spend more money on than just about anything. It's horrible.
By design.
Yeah, I know. I've designed a few myself.
There you go.
I know better. I want to talk about the rewards for a second. If I'm a business owner and I've got my Capital One Spark card and I don't have any affiliation other than I use them, and I get cash back on that, and I'm using that for business stuff, but I'm personally backing that card. I can get that cash out of there, and it's not insignificant. For me, it's quite a bit every year. $5,000-$10,000 of cash that comes back from that card. Tell the audience how that's beneficial to the person, not necessarily the business.
Well, you're touching on sort of a tax issue, if you will, and we don't do taxes. We're not tax folk. We don't do any of that. So
Talk to your CFO.
Yeah. Those are great ways. So again, we think, so that's very, very beneficial. We think that should be used. You can use it inside the business, outside the business. You're correct. You're backing it personally. You're doing all of that. So obviously check with your tax advisor around that, just because there's some arcane rules around that we don't keep up on. But separate from that, yeah. Separate
Don't
from
be
that,
afraid to ask for crazy stuff in finance.
correct.
You'll
We
be
think those
surprised.
are great things. We've seen people use that cash back for employee pools. We've seen it used for internal business uses. We've seen it used for personal uses, whatever that looks like, including the mileage, travel mileage, all of those things. Those are great things to do. What we're suggesting is something different. What we're suggesting is get rid of those things, invest that money, if you will, in a different platform that makes your control and your accounting much easier. And we think that's the trade-off. We have discussions about that all the time. Is it a hard rule? No. Do plenty of our clients still get mileage and cash back? Absolutely. But you should be aware that there are some opportunities to streamline accounting and opportunities to streamline control from some of these other platforms and still get cash back.
Yeah, I look at that cash back as a lever that I can use and pull it in different directions at will when it builds up to a certain amount.
Yep.
And
you're right.
That.
You're guaranteeing the money, and so it's rightfully yours.
Yeah. Ken, your article on the 13-week cash flow forecast highlights its power. For a business that hasn't used short-term forecasting, what are the first steps, processes, tools, and mindset to making it reliable?
Well, I smile when you ask the question because we love our 13-week cash flow forecast. We think that's That's a magic number. That's roughly 90 days. It's 12 weeks, but plus 1 week. We think that doing just that will give you tremendous insight into what is likely to happen tomorrow rather than what happened yesterday. And as you grow, working capital, cash flow, cash balance becomes your single most important item to manage, because the number of times I've heard my sales are up, but I have no cash is a direct result of accounts receivable. If my accounts receivable goes up, it's either because I'm selling more on credit or people aren't paying me, or in many cases, both, because sometimes increased sales are sales to less than the less than high credit customers, those sorts of things. So we think monitoring your cash is very, very important. I also want to stress that it doesn't have to be done to the penny. That's what usually gets in the way. Perfection gets in the way of actual good application. So I look at a couple of things. I look at the expense side. I look at when does payroll hit? When does rent hit? What's my average accounts payable for G&A expenses? And leave it at that. And I have a column for each one of those weeks. And now I know sort of what my 13 weeks of obligations are. That alone is insightful, because a lot of people get hung up on the cash receipt side. Well, I don't know what column to put it in because I don't know when my customer is going to pay me. Well, you do. You have some idea of that, and let's put it there. But let's at least start with the expenses. Now you know. I think it's more comforting to know that, okay, here's the cash I need for the next 13 weeks. Then I can start adding when I expect to get my receivables. And again, if you've got a collections process in your business, they can usually provide you with what's going to come in over the next 13 weeks. If you don't have a collection process in your company, this is going to highlight the fact that it's really hard to anticipate that, but maybe you should have a collections process in your company. So if you're finding that it's really, really hard to predict because people aren't paying according to terms, that might be a red flag that says I need some sort of a collection function. I need someone to spend at least an hour a week, at least 3 hours a week, at least 30 minutes a day doing this task. So that's why I like it. It highlights a couple of needs there. So those are the secrets, if you will, to getting that 13-week cash flow started at least.
Yeah, I've seen that happen. I've got friends that started businesses that didn't have a collection process in place, which blows my mind, specifically construction companies, because they can lean the building.
Yes.
And I'm like, why didn't you lean the building after 60 days? Like, what are you doing?
Yes.
Like, I can't believe that. So construction companies that go into business, like electricians, HVAC guys, and they don't know how to collect the money, and they let people go on net 90, and then on 91 days, they can't do the lien anymore. And it's just, and I feel so bad for them. Like, man, you could have just called and asked me a simple question on how do I collect money? And I would have just told you lean their building. And they don't want to do it, but that's their guaranteed pay. This is a system for a reason.
It's there for a reason. Absolutely.
I get so frustrated when I see construction companies go out of business because they didn't know how to collect money, and they're sitting on these huge assets that they could have executed on. It's really, really sad.
But nobody starts those businesses saying, I really want to create a system to collect money from these people.
Well, I think that's the precise reason you started your business. I want to collect money from people.
It's just, you need to have that mindset. It's very, very important,
I wanted to talk about, you said it doesn't have to be down to the penny. And I've fallen into this trap in my life for sure. And what I've noticed is that when I was dealing with $100,000 company, every dollar mattered. And, at $1 million, I can go, I can kind of swing it $1,000, $10,000 one way or the other. And today, I'm swinging in my head. If I need to come up with 50 tomorrow, I've got pretty good ideas on how I'm going to do that. Is that pretty common as you grow the business, that your flux, I guess, kind of what's in your head of your back and forth on your cash availability? Is that fairly normal, that it gets less intimidating to you?
So good points all throughout there. Number one, the CFO in me says a dollar is always a dollar, whether it's attached to a $50,000 number or a $5 number.
You're not just walking through your day.
Right. I just want to, I want to make sure I make that statement, because a lot of people kind of, as the numbers get bigger, they sort of overlook that fluff or slop or something like that. And so a dollar is the same, whether it's tacked onto a $50,000 invoice or a $5,000 invoice. But what you're really talking about is, how much noise can I tolerate and how much signal do I really need? And if you have cash cushions, if you have cash, working capital in your business, which I think you should, then you don't have to sweat those, I'll call it smaller decisions. You don't have to sweat those smaller numbers. Here's the important thing to remember though. And this is why I like estimating your cash flow and then seeing what actually happened and managing the differences. If you have a difference, if last week you thought you would collect $100,000 and you collected $25,000, very important to understand, is that a timing difference or a permanent difference? If it's a timing difference, meaning, I thought I'd get the check on Friday, but it was a holiday, the mail didn't come, it came on Monday. So now I have $1,000 that'll be in the following week, but it all rounds to the same number. I don't care about timing differences. They work themselves out. Permanent difference, that client decided not to pay, that's all hands on deck. That's all hands on deck, whether it's $5,000, $50,000, or $500,000, because first it's the money, like we talked about, but number two, it's a systems problem. Why do we have a delivery of product, delivery of a service, and someone doesn't want to pay? So we need to find out if that's happening elsewhere. We need to find out if that's systemic. Is it a problem just on them? Do we have a credit approval process? Do we have a customer approval process? What does that mean? As you grow, these problems have a tendency to multiply. And again, if you don't have a collections process, you might not realize that is not paid until 90 days, 180 days. And by then it's far too late to do something about it. And you might have had 10 other customers put themselves in the same position. Just knowing what should happen and what didn't happen and managing the permanent differences and letting go of the timing differences. I think that's what you're referring to, is those timing differences all work themselves out. And those numbers do get larger as you go around.
Yeah, the timing is because the electric company wants their money on a certain day. And,
Right.
and your customers don't. Some of your customers will pay you very, very consistently.
Some will. Yes.
But, you can get into enterprise businesses and they'll make changes on you like, oh, we just changed from net 30 to net 90. Or I have one that just went from 1 to 120. And like,
Yep.
well, you can't, now you're in breach of contract. And now you've got a whole nother book of worms that you might be opening.
Yep.
And
Yep. Be careful what type of customer you pursue, because the larger the customer, the more leverage they have over you, typically.
but the more leverage you have over them in court generally as well.
Yes. Yes. Yes.
So they do predatory practices.
Yes.
The
Not
big
all,
companies.
but some. Yep. Not all, but some. Yes, definitely. Or as they might put it, leveraging our assets, leveraging our marketplace position, right?
And they should.
justify it anyways. They justify it many ways.
They should do that. As a small business owner, you should stand up for them,
Yep.
them,
Yep.
and push them back as much as you possibly can. Can many small and medium enterprises run on gut instinct instead of on the numbers, especially early on? What KPIs do you think are non-negotiable, even for businesses with limited time and resources? And KPIs are key performance indicators, if you didn't know what that stands for. I'm sorry.
Yeah, those key performance indicators. So there are some that are universal to businesses, and there's some that are unique to your individual business. We like to think of about 5 in general and manage those at any given time. So some of the ones that come to mind for me are gross margin. I always want to know how much my revenue minus cost of sales percentage is. And is that growing or is it shrinking? What's happening to that? What's my 12-month trend? What's my 90-day trend? Well, there's all kinds of trending you can do around that to know instantly whether you're moving forward or backwards in that particular one. I think another one is expected cash versus cash on hand. Knowing you should have $100,000 at the end of the week and you have 70,000 is a good number, good thing to pursue. So that would be 2 of them. And then maybe the third one might be something around, let's call it sales growth, expected sales growth versus actual sales growth, because it all starts at the top of the business. And then I like to introduce, my favorite one to introduce is a non-financial metric, which is adding employees to some numbers. So if your payroll expense is going up by 5% a year, I don't know if that's good or bad, because you may have given out 5% in raises. Employee benefit costs might have gone up by 10 or 20%. There might be many reasons why your payroll cost is going up, but you have the same number of people. So if I take sales for the year or the month or the quarter, and I divide it by the number of people that I had, and I compare it to a prior period. So if last year I had $100,000 in revenue per employee, and this year I have $95,000 in revenue per employee. Well, I know that separate from any inflation, any changes in my numbers on the cost side, I know I'm less efficient. It's taking me more people to have less sales. So that's that's an indication of how well I'm leveraging my business, my fixed expenses. It also normalizes again for the rising costs. If you're if last year you had $100,000 in sales per employee for the month, let's say, and this year you have $105,000 in sales per employee, but you raised your prices by 10%, again, now I'm kind of falling behind the curve as well. But if last year I had $100,000 in sales per employee and this year I have 125,000 in sales per employee, let's pat ourselves on the back for getting some operational leverage and using people in a more efficient way. That's just kind of a magic number that we use. And then, you can pick a final one that's unique to your industry or something around what causes sales. So how many doors did the salespeople knock on? How many new customers did we introduce? How many new credit applications? What's our customer churn rate? How many people left us? Something around that. Those are the 5 that I would look at as a start.
Awesome. So I think that's money coming in, money going out. How much money do I expect to come in? How much money do I expect to go out? And then something in your wheelhouse. I couldn't agree more.
Resist the urge to add 50 or 100.
I've done it. It's not good. Those are department KPIs, not CFO KPIs, right?
Sure.
So
Yep.
understanding that each department will have its own KPIs, understanding that individuals might have their own KPIs is very important. Ken, I want to get a little personal on my side for a second. I don't normally do this, but this is a really big day for me in the world. It's September 18th today. My primary business is I operate a data center, president of a data center company, and interest rates went down today. Fed released that. We are going into winter months. So our electricity prices are going to be going down dramatically. And I've not really taken, because we don't know that the interest rates are going to go down until today for sure, right? What should I be doing over the next 60 days to recognize that reduced accounts receivable and optimize it to the best? Because I know that this is happening, but it's not appearing in any of my numbers yet. It won't appear in any of my numbers for 30 days. I just know this is happening right now.
Well, I would say the first thing I would do is create an expectation around what you think will happen. So stop and say, okay, I'm going to calculate to the best of my ability, 50% accuracy, 60% accuracy, 80% accuracy. 80% accuracy is a good number. That's a very, very good number. And then see if it plays out and then see what the differences are. So you might be thinking in terms of electricity usage, let's say energy usage, and that will definitely go down. But I would imagine that the cost per kilowatt hour has gone up significantly compared to the prior period, right? Not just the difference between summer demand and winter demand, but most people are paying more for electricity on a kilowatt hour basis this year than they did last year. Most are. Depends on how well your utility is run. There's lots of factors in there. But
by like 20%.
Yeah.
It's a big number this year.
So understand that your instinct might be telling you it'll match last year, but by actually doing the numbers, you'll realize, oh, I'm only going to get 50% of that benefit. So I better prepare for that. So that's, deconstructing the elements of the drivers, I think is important.
Yeah, I think it's really important for this CEO to be able to run way out into the future and then come back and bring some of his foresight. Like that's the vision seeking that a CEO needs to be thinking about and constantly running to the future and then running back to now and then running to the future and then running back to now. And then, crystal ball is not always very clear, unfortunately, but that's their job and it's a challenging one.
Well,
Ken,
I think the more that you try and measure things and fail, you get better at it. There's a muscle memory component to it. It might be difficult the first time to set up the spreadsheet to estimate things, but then you can have somebody fill it out for you. It's hard the first time, but it's relatively easy to implement a system, to have somebody sort of project, if you will, what's going to happen, and then you can review it.
Absolutely. Like some things that you could do really easily is have somebody calculating commissions for your sales reps and then have that report sent to you every week or every month. And that gives you KPIs on sales really, really fast and easy. They're doing their job and then reporting that back to you. That's the job. Ken, you've done both owning businesses and advising others. What lessons from being in the driver's seat still surprise you when you switch hats and serve as the advisor or a fractional CFO?
It's amazing how many businesses, business owners, and sort of the process of growing up in a business, it's amazing how similar the issues and problems are. They tend to be more alike than different. Almost every new client that we talk to says, my business is different. And there's an element of truth to my business is different. But your business is also very much like every other business. It's very much like the much larger businesses, the smaller businesses, business is business. As a small business, you might occupy a small part of the value chain, a small part of the ecosystem, whereas General Motors might do something from creating the iron to, destroying the car at the end of its life. And you just make door handles. You buy your iron or your chrome or your steel from somewhere else, but you're still part of that value chain. And there's all the same elements of business that run through that. And everything starts with an idea and everything starts with a risk. So entrepreneurs are wonderful for finding ideas and they're tremendous risk takers. And I think that what is important to recognize is that at some point, what got you here won't get you there. And that's the hardest thing to do. So when you're first starting out, you do everything you can for every customer possible. When you hit 5 million, 10 million, 25 million in sales, you're likely doing things for customers that you shouldn't be doing anymore. They're not profitable. In fact, they might be losses. They might be lost leaders in your mind, but they're still losses. And so I think it's understanding that as you grow up in the business, having all your sales with one customer or the majority of sales for one customer is a highly risky proposition.
Or
When
even
you're first
industry.
yes, or industry, any of that concentration. When you're starting out, it's a tremendous advantage. Tremendous. You can be very effective and very efficient with one customer. But over time, that becomes a true liability and an inability to sell your business as well. So I
Yeah.
think it's just recognizing that you need to de-risk things once you've reached a certain level, once you've reached sort of the flywheel effect, once you've reached the momentum, once you've reached the ability to trust things and know that things are going to happen, then it's time to start de-risking things and it's time to start letting go of control.
Yeah, absolutely. I'll tell you a quick story. In 2017, the center was rocking. It was 2016, we were crushing it. Right? We had, I'll say actually 2015, we had the largest coal companies in the world. We were managing their data centers. And in 2016, 3 major coal companies filed bankruptcy. And I went to from making some good money to a $4 million deficit in a day.
Wow.
Yeah. And it was because we thought, our hypothesis was coal industry is never going to go out of business, right?
Yep.
And we have the largest coal company in the world and the second 2 largest coal companies. And boy, oh boy, it took about a month total for 3 coal companies to file bankruptcy at one time and changed my life in profound ways really quick.
Yeah, profound is an interesting word to use, right? There's lots of other words you could substitute.
Yeah.
That sucks. That just sucks, right? You don't wake up every day expecting that to happen.
No, I also lost my founding partner that year and was diagnosed with liver disease. And we pulled up our pants and put on our boots and we're still here today, loving life and living it a different way, but we're still having a lot of fun.
How do you get experience? Make mistakes. How do you avoid making mistakes? Experience, right?
Yeah.
It's just you, and that goes back to your initial question that you posed. There's just all the mistakes that need to get made and just get through them faster than everyone else. Just be honest with yourself and just get through the mistakes faster. That's all you've got to do. You're going to be far from perfect all along the way. Get through the mistakes faster to get to the other side.
You can read, you can go to as many classes you want to go to. It doesn't matter. You're going to make the mistakes. We have to learn the hard way for some reason. I don't know why, but it's just humanity. As businesses scale, founders often struggle with information overload. It's a lot of stuff going on. What strategies or systems have you seen work best for keeping financial data clean, actionable, and timely?
So I think I'm going to talk about 3 different things. Number 1, I think you should always have an expectation for what the number should be so you can compare it to that expectation. Because if the numbers meet your expectation, you don't have to spend a lot of time on it. You don't have to spend a lot of brain power on it. You can move on. Number 2, compare it to a prior period to know if you're up or down, here or there. And, prior periods include trailing 12-month analysis, trailing 3-month analysis. Just try and know instantly what your current number is telling you in relation to what the last 3,
My number
6.
is this month last year.
Yep.
Like that's because my months are wildly different.
Yep. And then the final thing is, remember, we are visual beings. And so we think visualization is the key to truly understanding things. And it's not just a single graph. It's, again, no lonely numbers. It's graphs in comparison to other graphs. I like to chart sales and gross profit margin percentage to know if my increase in sales is coming at the expense of pricing. That's an easy one to do. We are visual beings. When we were cave people, we didn't look in the forest and say, there's a 23% chance there's a lion out there. We looked for lions, and those that couldn't see the lions, they're not with us anymore. those that could see them and differentiate the lion from the vegetation, they're still with us. So just remember that visual component is extremely important.
I love it. And in a day of AI, something that I've really learned in the last, I would say 3 years, and I've been learning more and more, is that all humans accept data in different modalities. And now that you have AI, you can use these numbers and these things to create different modalities very easily. Take your numbers and say, hey, give me a really cool bar graph for this, or give me an image that represents this, or give me a pictograph that represents this. And then you can take your data sets and represent them in multiple different ways very, very easily. And that tip can change your life, because you can communicate with different kinds of people much faster than you ever been able to be before. And you can just make your report and have the different modalities already laid out for your reader. It just ensures that they're going to absorb the data in the way that you anticipated them to do it. But you're going to serve it to them in the way that they understand it, which is wild.
Show me my sales trend for the last 12 months in 9 different formats. That's pretty easy to write.
Really easy to write. And I don't know that you need 9. I think you need it for the different senses that we can get on a computer, right?
No,
we can hear it, we can see it.
You're going to have 7 that suck and 1 or 2 that are super insightful.
Yeah, absolutely. I think that's one of the best uses of AI, is taking a static data set and presenting it in different modalities.
Yep.
If you just accept that truth of AI and implement it, you will become much more nimble than your competitors instantly.
Nimble's a good way to think about it. Nimbleness does result in success.
Yeah. In mergers and acquisitions, how important is technology integration, financial systems, reporting tools, and dashboards? What are common pitfalls in integration tech during an M&A event, and how do you mitigate them?
So we think that systems are extremely important because it shows that you have the ability to scale, and it shows you have the ability to understand your numbers quickly. We think that financials should be closed on the first, second, or third day of the month. We run across clients that don't close them for 90 days. They're waiting for perfection. And a financial statement that's closed with 95% perfection 3 weeks late, I could make the argument that a financial statement that's closed with 80% accuracy 2 days after the close of the month might be far more effective. And so it's less about the perfection of the financial statement than how can we use them to make decisions. Technology helps you do that. If you've got a 1-day close process, and we think that's possible, we really do, you can all of a sudden start doing weekly closes, because the reason you didn't do weekly closes before is it took 4 or 5 days to do it. So why would I do a weekly close if the week's already over before I get my number? But if I can do an hourly close or a matter of seconds close, I can close my financials every week, and I can get 4 looks at my data before the month end. Talk about nimble. So, and that alone, we'll talk about the sophistication that you exhibit in decision making. You're trying to set yourself apart from other people in that industry, other competitors that those buyers might be looking at, either a strategic or a financial. And just that level of detail is not usually found in smaller organizations. Yeah. Number 2, I would say, hey, go ahead.
Just keep the concept of, I manage the checkbook and the accountant manages the financial and the and I just look at, like, I'm managing the cash as it's coming through and doing that stuff. But then the accounting pieces, and I just look at that report monthly. But
yeah, and then to the second part of your question about, what are the difficulties in the acquisition process? Due diligence is something that, if you haven't been through it, it's the equivalent of a very painful health check on your entire organization. And I like to comment that from a buyer's perspective, due diligence is rarely a value additive process. They're looking to find anything they can to start deducting from the price that was mentioned in the letter of intent. They're looking for anything that might be there that would impact value so that they can, in essence, drive down the price of it. So I suggest doing due diligence before you go to market. Find out now if you have sales tax nexus issues in any of the states you look at. It's not a question of, we don't really sell too much to them, so they're never going to catch us. In a due diligence process, they're going to identify exactly what that liability looks like, and they're going to reserve for it. It's not a question of you making the judgment that it doesn't matter. Someone else is going to decide that really does matter. So, and they're going to be the ones paying for it 3 years in the future. So that's when you get introduced to the reps and warranties portion of a mergers and acquisitions document. That reps and warranties, that's where you're basically signing off on these things that you say will happen. And if they don't happen that way, it comes out of your pocket.
Yeah. And they're going to ask you for stuff like no tax due letters from every state.
Yeah.
And you're going to have to go to so even if you tried to like skate it from some places, you're going to have to go to that state and say, hey, or potentially you might have to go to them and say, hey, I need a letter from you saying I don't owe you any taxes. And then, well, that's going to open a whole can of worms because they're going to scratch your head and say, well, maybe you do owe us some taxes. Let's look at that.
Unless you had a process that said, are the Nexus rules for every state we do business in. And here's the report we run every month, every quarter, and every year to date to make sure that we don't follow for Nexus. And we've done that for the last 3 years. Again, nobody has this stuff, but if you have something like that, that's a $1 billion business process sitting in a $5 or $25 million company. That sets you apart.
Yeah, and those kinds of processes do help. You talked about due diligence, and I've been anywhere from 35 to 40 acquisitions in my life, on either side of that fence. And I've done the due diligence. The most common thing that I found is we've bought customers that didn't actually have the service, right? On the selling side, that was the most common thing that we found. So tying each individual customer. So now we look for that, right? Like, how do here's your top 100 paying customers, show me their specific deposits, right? And tie those in very, very closely. So if you're thinking about selling at some point, these are things that if you have a seasoned buyer, they're going to be asking. Like they're gonna, because, well, they've been burned, right? It's just that simple. They know how to ask these questions, and you're not going to be able to hide it from a seasoned buyer. You might be able to get through with some cowboys, but
well,
you talk about.
And cowboys don't often have the ability to close, right? There's that too. I do want to make a point here. I have a talk that I give called, why an unsolicited offer is the worst thing that can happen to your business. When it comes to the mergers and acquisitions process, it's time to set your ego aside. Your buyer knows far more about your business than you do. And you might say, how can that possibly be? I've been in this business for 25 years. I built this business. There's no one that knows more about that business than me. Your potential buyer is going to have talked to 5 of your customers and asked what you're doing well and what you're not doing well. And you might say, oh, well, I pretty much know that because the last time I checked in was 4 years ago. And they're going to go to your top 5 vendors and they're going to ask what's coming up. Are you have price increases, decreases? What's technology? What's happening? They're going to go to your 5 competitors and ask what they're doing well, what they're not doing well. They're going to know more about your current business than you will. That's why I'm saying do that due diligence now. So, and by design, I know people that sit in the chair of strategic buying in the M&A side, and their job is to get your business for the least amount possible. And if there's no deal that gets done, it's to get the most information out of the process as possible. That's their job. As nice as they are, as wonderful as they seem on day one, they're really, really, really good at it. Most business owners have done 0 to 1 transactions in their life. So recognize that from the moment you start, you're outclassed. You can't catch up in the process.
No. And that's where I've been in a bunch of them, and I'm in the process of one at the moment, which is fun. And I don't have a broker. I probably should. If you haven't done it, get a broker and find somebody that you really trust to help you through that process. Cause it's a lot, man. And then you got buyouts and like just all kinds of wild hockey stick moments through this process that can trip you up pretty quickly. Ken, I've had such a great time talking with you, and I'm going to kind of buzz through this last question and then we'll get on to the ending. You talk about accounting optimization and financial advisory within your services. Can you share a case where small improvements in process or reporting yielded outsized gains in business value?
My favorite stories usually revolve around sales and accounts receivable. We picked up a client that they were in the home building industry. They ran surveys for home builders when the home closed, 90 days after the home closed. And did the punch list get done? Were you satisfied with what was happening? And there was some really good data in there. And so they would get reports from all the home builders of how many closings there were, how many surveys were done, and they charged by the survey. It took them about 3 weeks to manually invoice all the different customers, and then they paid right after that. The home builders were really happy with the service. They usually paid pretty quickly. It was a small amount for them, and all was good. We said, look, we want to automate this process. We think that report should be done by the customer online and filled out on a form. And by the 3rd day of the month, we probably have all the data we need. And then we electronically generated all the invoices so that the clients got them on the 4th day. And many clients started paying on the 5th day. So instead of a 3 to 4 week cycle, it was a 3 to 4 day cycle. And after about 3 months, the owner came to me and said, Ken, you've changed my business. I used to have $150,000, $250,000 sitting on my credit cards every month. Now I pay those credit cards down every month. I have zero debt. Now I can make decisions about my business that are not constrained by resources. I am not worried about my business. I can think strategically about my business. You've changed it in a short 3 months. So those are some examples. It's probably an extreme example, but something that was relatively easy to do. They just didn't realize they could do it.
Yeah, it's not uncommon, especially in the bootstrap world, to where I'm starting my business with debt, right? Because I'm taking the customer, I'm buying computers or whatever I'm buying for them, and I'm holding that debt until that customer pays. And that's not an uncommon situation. So if you can speed up the process of getting paid, it goes right back to that construction worker that didn't put the lien in on time, right? Speed that process up as fast as possible. It's just business. Everybody expects that they're going to be paying. There's no negative in you saying, hey, you owe me money. You need to pay this. How are we going to get paid? It's just part of the deal, right? So I don't.
Remember,
I have the same problem with one of my businesses. So
remember, we've always done it this way is not always the best answer to how we do things.
Rarely the best answer. Like, if nobody steps back and says, why are we doing it like this? It's rarely the best answer.
And that's where an outsider can really help, right? We can ask those questions, right? We're the dumb person coming in asking the stupid questions.
And as the founder, try not to get frustrated with explaining the 7 reasons why it's this way. This is just somebody that's coming in, they're looking at buying your business, or they're doing an audit. They're on your team. They're just trying to understand why it's that way. I know that I had that problem for a long time of being frustrated with auditors. Like, why are you in my business? Get out of here. I'm like, well, I'm paying them to give me this information. It should be nicer. Ken, we're coming to the end of the show, and Diary of a CEO is my favorite podcast. Are you ready for your question pool?
I am.
This one's from Dame Dash. What is your selfish dream?
My selfish dream.
Your selfish dream.
Selfish dream. I got to say, sitting on a boat somewhere, watching the sunset with some concoction in my hand, knowing that everything I've created in our businesses and our clients is going very, very well.
Mine would be a private island with beautiful women everywhere. But realistically, it's being talked about at dinner tables in 100 years from now. If you've got a selfish dream, please share that in the comments with us and tell us what your selfish dream is. And be selfish here. Sometimes it's important to be selfish a little bit and figure out, why are we doing the things that we're doing? Ken, thank you so much for your time today. I appreciate you.
Thanks for having us, Ken. Really appreciate it. Fun dialogue. Thank you.